Trading two markets within a single asset class is one thing, but there's also potential in trading different asset classes. Trading not so similar markets can reduce risk by way of diversification and help speculate on relative performance. The first level of diversification for most people is simply spreading an investment across multiple stocks. But stocks tend to have high correlations and move up or down together. Going back to the correlation measure introduced in the last video, diversification is found in two markets with a correlation close to zero. For example, a portfolio that mixes stocks and metals is often referenced as true diversification, given that their correlation is usually between negative 0.5 and positive 0.5. But replicating diversification with stocks and ETFs, which demand 50 to 100% of the product's value and capital requirements, can get expensive. And traditional futures are so large that a single contract in these two diversified markets can add up to hundreds of thousands of dollars in exposure. Small exchange products cover stocks, metals, and more. They require just 1 to 10% of the product's value, and they have an average value of just a few $1,000s. Building a diversified portfolio with smalls products that are efficient like futures and adaptable like stocks is an easier alternative. Markets filed under different asset classes can also come together for more pairs trading possibilities. Though pairs are traditionally traded between two markets with correlations near -1 or +1, opportunity is also present in less than perfect correlations. Take equities and interest rates, for example, which have a correlation around positive 0.5 for yields and negative 0.5 for bond prices. The phenomenon known as flight to quality says that bond yields move lower and thus bond prices move higher as stocks fall, and vice versa when stocks rise. Traders can take advantage of divergences in this relationship or the simple lagging effect sometimes seen in one market relative to the other. This type of pairs trade is usually established with a longer time frame in mind than those with stronger correlations, to allow for the imperfect relationships to shake out. And this can get risky for those using big futures contracts or expensive for those sitting on the high capital requirements for stocks. Small exchange products offer a middle ground that lets more inventive pairs trades like stocks and interest rates or crude oil and dollars play out in the market. Whether it's diversification and risk management or pairs trading and speculation, trading across different asset classes has its merits, and the smalls facilitate that trading with ease. The Small Exchange. Big ideas about futures.